Howdy, Jacob here. Today we're looking at Fluor Corporation in the construction engineering industry. Almost 8 billion market cap with just over 6 billion enterprise value. So initial look looks like there's a lot more cash on hand than debt. They provide engineering, procurement and construction, fabrication and modularization, operation and maintenance, asset integrity, and project management services worldwide. Founded in 1912. So been around for quite some time. And we're actually seeing revenue decline over the last 10 years. On the free cash flow statement, we're going to look at whether they're, or statement of cash flow. We're going to see whether these were sell-offs or not, or whether their business is actually declining. And similar to the last business we just reviewed the other day, gross margin is single digit, operating margin single digit. Again, there's only so much you can do when your gross margin is as low as this. The cost it takes to sell your products is that grand. Just really tough to push that revenue and bottom line especially. And so they used to pay a dividend, haven't recently. Looks like earnings used to be a lot greater than they were today. And so let's look further into this company. So income statement, like we said, cost of goods sold is a heavy amount of their earnings. They had weirdly high SG&A in 2021, but much more consistent with what they've done historically. 2015 was also very high. So not sure what exactly happened there, but maybe there was a huge demand and they had to contract a bunch of work. Who knows? If this looks like a decent price, those might be things that I look into. Balance sheet shows 2.5 billion cash-like products with no short-term debt and 1.1 billion long-term debt. So as we saw from the difference in enterprise value and market cap, they do have more cash on hand than short-term and long-term debt, which is positive. Again, that means you can use more money for capital allocation purposes. So that can change your valuation if they are allocating that capital well. Their cash flow statement shows a declining production of free cash flow, but their capex is also going down. I don't see any devastations under acquisition, but there are some sell-offs of short-term investments. So I can't really pinpoint exactly why the revenue is declining as much as it has been, but they have started to increase their reinvestments and acquisitions. So hopefully that spurs some growth. And it looks like the last couple of years we have seen some growth, not much. And so, I mean, I think that's enough to get me to make some assumptions here. I don't think we're looking at anything sexy here. So probably 2% revenue growth based on their based on the fact that they have $1 billion net cash. I'm comfortable increasing that P and price free cash flow. If it were pretty much even, I'd go with maybe an 11 or 12 here, but I'm going to go closer to market average, even though their growth is a lot lower, much lower margins, much lower return on invested capital, just based on the cash, the fact that they have $1 billion net cash based on their 8 billion market cap is 12.5% of that. And so if they're able to allocate that capital well, I think there deserves a little bit of premium from what it would have been. And for margins, I mean, we're looking very low here. I don't know. Let's do 0.8 and 1%, 0.8% and 1%. And then for share change, 1% for them is about 80 million. I mean, we're not really seeing much movement here. Stock-based compensation is maybe half that. So maybe increase the shares about a half. And it's nowhere near the price we're looking at. So this would be something I would not waste my time on whatsoever. 4 minutes and 40 seconds or so is more than enough to waste on this. So hope you enjoyed the video and have a great rest of your day. Appreciate it.